All right, guys. Hey, thanks for having me on. Like Jeanette said, it's kind of last minute. I did put together a little report for a lot of my members. If you guys don't know who I am, my name is Ross Gibbons. I run a service called the Insider Report, what I do is I track the activity of insiders. It's going to be CEOs, CFOs, corporate executives, folks that have access to inside non-public information about their companies. And I'll show you in just a moment, they have an impeccable track record of buying the lows and selling the highs, and they are without a doubt the most skilled at nailing market bottoms. So I think they're the most important people to be watching right now. Quick disclaimer for all the lawyers in the room. Here you'll see this 5 times a day, but just got to do my part. Now, first things first, this is not normal, okay? This is not normal. If you're sitting there going, how often does this happen? We lose 32% in a month. The answer is never. It doesn't happen. This is the absolute truest definition of a black swan event you will ever see. It is completely unexpected. It came out of nowhere. It is unheard of. And so if you are um, kind of scratching your head and just baffled by this, you're not alone. The smartest guys in Wall Street are baffled by this as well. So what I want to do first, I want to show you kind of what we can expect, some history of some big drawdowns, how quickly it took those to recover, and try to get an idea of what we can expect. Now, this is all the drawdowns of roughly 30% or more in the market going all the way back to the 1920s. And it shows how far the market recovered a year, 3 years, and 5 years later. Now, a couple of these we kind of want to throw out. What happened in the 20s and 30s. Um, I don't think you can really compare today. It's a very different market, right? You're talking about a time when they barely had telephones, and guys were writing paper slips and carrying them across the trading floor, to a time where you and I can pick up 1,000 shares of Microsoft on our cell phone in half a second. So it's not the same market. But one thing I do want you to notice from this, the peak to trough moves, none of them happened in a month. I mean, the shortest one is down there at the bottom in 1933. It took 3 months to fall this far. We go back to '08. That was a 56% drawdown. A lot of people are going, man, maybe we could get cut in half like that. Well, it took a year and a half. It didn't take 4 weeks. Regardless, what I do want you to look at is the 1 year, 3 year, and 5 year returns were all positive after these drawdowns. So as scary as this is right now, it should offer some reassurance that whether or not you pick the bottom, stocks will come back. They always have, they always will. And what you need to do is step back from the fear and treat this like the opportunity that it is. So, first things first, what do you want to avoid? A lot of these are going to be no brainers, but I want to point out a couple of things. Now, I stole these charts from Motley Fool. I left their logo on there, so didn't think I stole it. These are the airlines and what's happened as of Thursday's close. As you see, they're down anywhere from 40% to 80%. And a lot of people, especially kind of value players, are going, man, these are some great buying opportunities. Because when a stock goes down 80%, if it goes back to where it was, it's a 400% gain. So you're thinking you make a lot on the top. I would caution you against buying any of these unless it is absolute risk dollars you are willing to throw away. Because when a stock is down 80%, it's not because things are bad. It's because people don't think it's going to exist in 6 months. Buying an airline today is not a bet on how soon it will return. It is a bet on whether or not it will continue to exist. So as someone told me once, it doesn't matter if you buy the stock for $80 or $8. If it goes to zero, your loss is the same, 100%. And that's what's going to happen with these airlines. Now, Trump's talked about bailouts. I'll be honest, I did think about playing some of these because I do know, Trump is all about image and reputation in the markets, and he is going to put our tax dollars into bailing some of these out. But I don't think that's going to necessarily save them. He's not just going to give them money. It's going to be loans, especially because of the fact that once he realized that these airlines have spent billions of dollars in share buybacks, which is a way to boost their stock price, he's going to get a little pissed, and the public is going to say, this is not fair. These guys used all their profits to boost their stock, to get them paid, and now we've got to bail them out with our tax dollars. So it's not going to happen. The government's going to take an equity stake. They're going to either give them a loan or let some of them fail. It's just not worth the effort. The same goes for the cruise lines. They're getting absolutely demolished. If you take, I looked at, I think, Carnival the other day. I mean, they've got their expenses on a quarterly basis. What it costs them to operate is around $700 million. Well, they're not even running their ships right now. and they only have about 150 or 200 million in cash. They're not going to make it. They're going to go bankrupt, and the government's not going to bail these guys out. So again, I think this is just throwing bad money away. Now, if you are looking for a place to stash some cash, there are some safe haven stocks. Now, these stocks are not going to double next month. They're not going to double next year. But if you're sitting there, you have friends going, man, I can't take it anymore. I can't let it fall another percent. I need to buy a stock that's not going to go down with this. Here's 3 easy ones you can get. Number 1, Johnson & Johnson. As you see, since the beginning of the year, the stock's only down 7% versus the market's 26% fall. J&J is a very consumer staple company. They make everything from toilet paper to toothpaste to orange juice. I mean, they're all the basics. They're things that people are going to buy, whether we are in an economic boom or in an absolute recession like we're entering now. So it's very much a safe haven stock and an easy place to store cash. The other one is Amazon. Amazon, in my opinion, is the only company that is actually going to do better during this coronavirus epidemic because, I mean, if you can't go to the store and you can't buy, you're only going to buy more from Amazon. Okay, they're not going to take a hit. Now the stock is going to fall a little bit because of this drawdown, but as you can see, they're barely down any. This is probably the safest place to put money. And again, I was hoping Amazon would come down to like $1,200, be the deal of the century, and I just load up on it. Right now, it's trading around $1,850, $1,900. It's not down off its highs much, but it's a very, very safe place to put money. It's really not going to go far. And finally, Walmart's another one. Obviously, a big staple. This is one of the few stocks that's actually up this year while the market is collapsing. And we've seen really stable returns out of this. So that's just some safe places to put cash. It's not exciting. It's not sexy. But if you're going, man, I can't do this anymore. I need to park my money somewhere, but I don't want to be in cash. I don't want the market to pop back and I not be a part of it. Some very safe stocks to put your money in. Now, when it comes to surviving an epidemic like this, obviously what you want is cash. You want companies that can survive. You want 2 things. One, companies that don't have a boatload of expenses. So if you're looking at, think about what it costs to run Ford Motor Company or United Airlines. I mean, you're talking about billions of dollars in loans and machinery and employees. They're very bloated companies. And when you have to send everybody home, nothing happens. But what if you run Microsoft? They're all working behind computers. They can work from home. They can do it from anywhere. Their costs are much lower. So they're much less capital intensive. They also have a ton of cash on the books. They can weather pretty much any storm. So these are the companies that have the most cash on hand. I guess Berkshire actually should be in there as well. They're a little different as a conglomerate, but these are safe companies that can pretty much weather any storm. Now, this is really what I wanted to show you today. This is the information that I think is going to make you a lot of money. Now, what you're looking at is something called the insider buy-sell ratio. So as I mentioned in the beginning of this webinar, insiders are the folks who run the company, the CEO, the chief financial officer, members of the board of directors, 10% owners. These are people who have inside information, okay? Like the CFO, you wonder what earnings are going to be. The CFO literally fills out the earnings report, okay? So who better to follow? Now, I'm not talking about what they do with company money. When they buy their stock with their own money in their own personal account, they have to report that information on what's known as a Form 4. These filings are made public, and you and I and everyone else can see them inside of 48 hours. So it's public record. A lot of people don't know this. They don't know how to find them, but it is out there. And the chart you're looking at here is the insider buy-sell ratio over the last about 17 years since we began tracking this data. Now, the green bars are the buy-sell ratio. So the higher the green bars are, the more insiders are buying, and the lower they are, the less they're buying. And I want you to look at the areas where it was the highest. We had right here at the end of 08, early 09, big spikes. Obviously, the best buying opportunity in 2 decades. We had the 2011 pullback, bought big, the 1 in 15. Whoops. Do you remember December of 2018 when the market fell 20% in a month and then rocketed up in 2019? Look at how big they bought there. And I want you to look at this bar all the way here to the far right. That's March of 2019. That's this month. Look how high that is. It's almost as high as it was in '08. It's higher than it's been in over 11 years. Highest insider buying we've seen in a long time. So to me, this is a fantastic signal that this is a huge, huge buying opportunity, and the smart investors, the folks who know what's going on, are taking advantage. They're loading the boat and they're putting their money where their mouth is and buying this stuff up. Now, the last time this happened, as I mentioned, December of 2008, here were some headlines from that period. Notice the date on here, December 28, 2018. Record insider buying suggests we're near a bottom. The insider sell, well, they call the sell buy ratio. I look at the buy sell. Hasn't been as bullish as November '08. It's high, high, high. We think this could be an opportunity. You know, this is when that article came out. Not a bad time to get in, right? So it is in these times of absolute fear when the calm investors and the insiders who know how bad or not bad it's going to be and what's happening to their companies, that they're the ones who know when it's a great time to buy, and they're saying today is that time. Now, that's why I would pay attention to this chart, and that's why I've begun buying stocks now pretty heavily and will continue to on the way down. I'm going to show you in just a minute my strategy for getting all in. Now, if we break that down further by sector, so this same chart I showed you here, I've looked at it by each sector. I'm talking tech stocks, financials, consumer staples, to find the areas where insiders are buying the heaviest. And so if you're kind of want to get a little bit tactical without actually picking stocks, but just maybe do some sector ETFs, say, well, I want to get in the market, but I don't want to buy airlines, I don't want to buy cruise, I don't want to buy travel stocks. I'll show you the three sectors they're buying insanely heavy. Now, the first is energy. This shouldn't be a surprise. Crude oil touched down below $20 a barrel the other day, which is absolutely insane. I filled up my F-150 at $1.74 a gallon, which was fantastic. I felt like I was in high school again. They're loading the boat on energy stocks. Now, whether or not this is early, I don't know. I do believe that if you buy these stocks 2 years from now, 5 years from now, they'll be much higher and you make a lot of money. But this number well above '08, well above anything we've seen in 2 decades. And if you want to play just an energy sector ETF, that ticker symbol is XLE. Second one, financials. We're talking bank stocks. We're talking financial services. This is PayPal. It's Wells Fargo. All those type companies. Again, insider buying even higher than it was in '08 when a lot of these stocks were getting pummeled. And obviously, insiders believe this is a fantastic time to take advantage of that as well. They're kind of getting their hands tied. Trump got together the 8 CEOs of the largest banks, got them to agree not to do any buybacks for 3 months, to use their capital to lend and fuel the economy. And it's pushed their stock prices down and made some really, really great deals out there. I mean, you look at Wells Fargo, it's like half off. JP Morgan's down around 40%. So some really, really great bank deals. If you play, I would do one of two things. I would either buy the IYF, which is the sector ETF, or, don't get fancy. Don't try to buy the little bank that's fallen the farthest, might have the biggest. Just get the best one. Okay, get your Wells Fargo, get your JP Morgan, get your regions, get the banks that are the largest, that are not going to fall, by Goldman Sachs, and just play it safe. In the third sector, and what I think is the biggest opportunity because it is so boring and because nobody's watching it, are basic material stocks. Now, this is the highest insider buy ratio of any sector of any time over the last 2 decades. It is insanely high. Ticker symbol IYM, or any of your scanners you run, you're looking for stocks, just click, see what sector they're in. And basic material stocks, those that make polymers and aluminum and steel and all the boring stuff that's not sexy. I think it's some huge, huge opportunities here, because when we get into these stimulus packages and what's going to happen to fuel this economy, look, regardless of whether you like Trump or you're not, he's a spender. Okay, he doesn't care about debt. He's going to pump, he's going to print money, he's going to use it to boost the market as best he can. And I think a part of that we're going to see in the next 12 months is going to be a huge infrastructure plan, and we're going to see the government spending billions and billions of dollars building roads and bridges and tunnels and things that require a lot of basic materials. And these companies are going to make a fortune. Their prices are depressed right now. It is a probably once in a lifetime buying opportunity in the stocks. So what I got, about 10 minutes left. Okay. I'm going to go over something really quickly. This is, you haven't seen this anywhere. I didn't steal it from anybody. It's something I came up with. It's what I'm calling my tiered leverage plan. It's how I'm putting my money into the market. Now, if you were 100% invested when this is going on and you have no cash on the sidelines, I would encourage you just to stay the course, ride it out, and quit looking at your statement, because selling when we're already 30% down doesn't make a whole lot of sense. The worst thing that could happen is you sell the bottom and then you buy back higher. It just rarely works out to get out after such a big hit and get in much lower. So what I'm doing with all the cash I've got is a tiered leverage plan. Now I just put these aren't the exact numbers I'm buying. I actually started buying a little bit higher than this, but here's the overall strategy behind this. Let's say you've got $30,000 you want to invest, okay? Instead of picking stocks and picking sectors, we're just going to play the entire S&P 500 index. So what I'm doing is splitting the money into thirds. So take 10 grand, 10 grand, 10 grand, and pick 3 levels. And I'm going to put 1/3 of my money into the market at each of those levels at each of these 3 ETFs. Now the SPY is simply the S&P 500 ETF. It's 1 times leveraged. If the market goes up 10%, it goes up 10%. If it goes down 10, it goes down 10. SSO is the double long S&P 500. So if the market goes up 10%, SSO will go up 20%. And then UPRO is the 3x long. It's going to move 3 times the market. So 10% to 30% move, etc. Now, the reason for doing it this way is you are increasing your leverage as stocks go lower. So you are not only lowering your cost basis, you are doing so exponentially. And it does a couple of things for you. For one, if you buy and it keeps falling, you're not sweating, you're not selling, you're actually happy it keeps falling because you're getting even more money in at lower prices. And the second thing is, the lower it falls, the more you stand to make. Now, let's go through a couple of scenarios. I just threw these numbers up there. To be honest, I put in SPY when the SPY was at 2,500. That's where I started buying. And then SSO lower and UPRO a little lower than that. But you got to kind of look at a chart, take your worst case scenarios. What's the lowest thing or how low could this possibly go? So let's say the market just came down a little bit more, right around in here between the green and yellow, and popped higher. That's probably worst case in this play out. In that situation, well, you only got 1/3 of your money in, and you'll have to buy the rest on the way up. Okay, so the kicking yourself is that you didn't get enough invested. Scenario 2, stocks come down, hit the yellow line somewhere between yellow and red, and push higher and start the reversal. Well, in that situation, you only got 2/3 of your money in, but you got 1/3 of it in at 1 times leverage. You got 1/3 of it in at 2 times leverage. So you're essentially 100% long. And because you're in twice as much from the lower level, you're really, if this was 2,300 and 2,000, you'd be essentially like 100% long from around 2,100. Okay, so you'd still have a little bit of cash left, 1/3 of your money, but because of the leverage, you're 100% long, and you're going to perform fantastically. And then finally, if it comes down and hits your red line, you put your final third in at 3x leverage, you're going to end up being net double long the market. So between the 1, the 2, and the 3, you average it out. You're double long from somewhere down between the red and the yellow line, so near the bottom. And as long as you get this done at a price where you go, there's no way the market gets cut in half from here, you're pretty much guaranteed to come out very well. So, for instance, if your UPRO, your 3x line was call it 1,700, what you're saying is there's no way this market S&P goes down to 900. That's just insanity, and I don't think it's possible with this situation. So as long as that doesn't happen, you're gonna come out like gangbusters. You're gonna be double long. You're gonna beat it from down here, and because you're double long, let's say this is at 1,700, the market's going back to 3,400. Once it gets halfway up, so once the market got back to, and I can't do the math in my head right now, but call it 2,500, 2,600. you're back to break even. You've recouped all the money that you would have lost on the way down, and when it gets back to new highs, you've done twice as well. So this is my tiered plan on the way in. Now, Mimi's asking, are you not concerned with GDP outlook and horrible unemployment numbers? Mimi, of course I am. I mean, I don't like that. That's why stocks are down 30% in a month. Look, let me tell you what's going to happen. GDP is going to shrink. 2020 is going to be a bad year. We've had nothing but economic growth for the past 11 years, and it's stopped. Our gross domestic product will be less than it was in 2019. Unemployment will be higher than it has been in 5 or 10 years. It's just a fact. When you shut every restaurant, bar, store, physical location, business, shipping industry, airline, when you shut them all down, nobody can work and no money comes in. But how long is this going to last? A month, 2 months? What's worse? Maybe 3 months? Okay. So for 1 quarter, everyone's going to take a big hit. But we will recover. We will come back. And when we do is when you're going to make the money. The only way to make big money in the market is frankly to have the stones to buy when everyone else is selling. And if all you can look at is, oh, I don't know, this is scary, I don't want to get in, you shouldn't be trading stocks. You definitely shouldn't be buying stocks. And it's nothing personal, but as Warren Buffett said, if you can't watch your money, if you can't watch stocks go down 50%, you shouldn't own them. And that's just the cold hard truth of it. If you don't have the ability to stare in the face of scary stuff and say, I'm buying, you shouldn't be in a stock market. If you can only buy when things look glorious and great and fantastic, you're gonna get pegged. You're gonna buy last year and take these kind of hits. So yes, I'm concerned, but how bad is it gonna be? You know, is this something that's gonna last, drag out 2, 3, 5, 10 years? No, it's just not. We'll hit a recessionary period. We'll come back, and as soon as companies start reporting earnings and people realize, oh, they're not as bad as we thought. Yes, it's a bad year, but next year's going to be better. The next year's going to be better. The next year's going to be better. Stocks will rebound. They will come back, and you will see them above the previous highs we saw. So that's kind of what I'm looking at. Yes, maybe bear markets can average 18 months, but in none of those 18-month scenarios did the market fall 30% in 4 weeks. So it's just a different one. And even if it takes a year, I'm not saying it's going to happen next week. It's going to come back next month, which is a longer term way to play the stocks and get in. So this is what I'm doing. You can do with it what you will. I think this is a unique way to buy in, so that you're almost cheering lower prices. You're not scared of lower prices, and that you were constantly bettering your long position as the lower we go. And frankly, I would love the thing to come down to the red level to hit the bottom. I'd love to be long all my money double from a super low price. It just means it's going to make more money on the way up. So yes, this is the SPX. We're looking at the SP 500 index. Now, Will asked if I have a hedge for the 401k. I do. I put together, as Jeanette mentioned, a very in-depth report on all this, covers all this information. The sectors, you can see the insider buy ratio of every single sector. I'll show you my plan, how you tweak your 401k to take advantage of this bear market, how you can recover much faster by doing that, how to take a big win in a sector that usually is a loser, and really position yourself to do fantastically. Again, if you're in retirement now or a year away, that changes things. But as long as you're not within 2, 3, 5 years from retirement, the tweak I'm going to show you in your 401k will make you a lot of money and will actually have you come out better in a situation. So if you want to take a look at that, I believe it's 197. You have to ask Jeanette. She put the link together, but TradeThirsty.com/bear will show you all that information, and you can pick up a copy of that, put it to work in your account. I appreciate the time to come talk to you guys. Hopefully I didn't give you too much of a headache, but just wanted to share what I'm seeing in the markets, some safe areas, some scary areas, some ways to play it, and not overcomplicate things for you guys. I'm sure the other speakers are going to have their own opinions and hopefully give you some more insights, but hope you guys have a fantastic Saturday. I hope this helped, and I'll see you on the next webinar.